Hi, today we're going to learn about accounts from incomplete records, also called as single entry system. Incomplete records. We might have already studied that we maintain accounting records on double entry system. Double entry system, right? So how does it work? Let's just say you have made a sales for cash. So general entry will be cash account debit to sales account, right? So in cash account you'll write to sales. In sales account you'll write by cash. So you are entering the same entry at two places, so this is called double entry system, right? So we maintain all our accounts in double entry system. But whereas some small sole proprietorship or partnership, they do not maintain any double entry system. They can't afford to have an accountant to maintain all these things, right? So all they do is they maintain one book. In that book they will record how much cash they received, how much the cash they paid, right? So they want, if there is a cash account debit to sales account, they won't maintain this, they will maintain only this, right? Only one account they will maintain. So that's why we'll call this as mostly single entry. So this is also called as single entry. So instead of maintaining double entry system, they will maintain only single entry system. So, but whether it is a big company who maintains accounting in double entry system, or whether it is a small company who maintain accounts in single entry system, at the end of the year they want to know how they performed, they want to know how much profits they got, right? So if it is a double entry system, obviously we'll prepare trading account, P&L account and balance sheet, and their accountant will figure it out how much profit they got. Now, if you have maintained incomplete records, right, there is no complete information whatever the records you have maintaining. And these people also want to know how much profit they made. So they will go to an accountant with these incomplete records to find out how much profit they made during the year. Now, accountants popularly they follow some method called as capital comparison. Capital comparison, right? Let's just say in 2019 we have started a business, that means with the capital of 1 lakh, right? At the end of 2019 December, let's just say this is John and then this is December, you have a money with you 1,50,000. What does it mean? You have started with 1 lakh and you ended up with 1,50,000. Obviously 50,000 profit you have made during the year, we can say that, right? Okay, so now we can call this as opening capital, we can call this as closing capital. So if the client comes to you with incomplete records and he wants to find out how much profit they made, so all you follow is capital comparison method, right? So according to this method, if you compare the opening capital and closing capital, you will find out the net profit you have made during the year, right? Okay, but it's not that simple. Sometimes there may be yeah. So we can find out the profit by comparing the opening capital and as well as the closing capital, right? But in some scenarios there may be additional capital, right? In the previous example we just seen that the opening capital is 1 lakh and the closing capital is 1 lakh 50,000, and then the profit is the remaining is profit as 50,000, right? But if there is an additional capital, let's just say he added 20,000 as an additional capital, then his capital will become 1,20,000 and then his profit will become 30,000, right? So his profits will change when there is an additional capital and then when there is an drawings. Let's just say he withdrawn 10,000. So as of now he contributed total capital is 1,20,000, and if we withdraw 10,000 minus 10,000, so he actually contributed only 1,10,000 only. So here 1,20,000 he contributed by adding the additional capital, and if you withdraw 10,000 he actually contributed 1,10,000 only. So his profits again will change to 1,10,000 is the opening capital and the closing capital is 1,50,000. So his profits are 40,000. Sorry, just his profits is 40,000 because he's totally contributed 1,10,000 and 1,50,000. So if you see, when there is a drawings and then when there is additional capital, it's changing the profit. So simply we cannot compare the opening capital and closing capital because there might be additions of the additional capital or drawings during the year, so which might affect the profits. So we need to consider that. So that's why they came up with a format. The format is, first start with the closing capital, add drawings, minus additional capital, minus opening capital. What you will get is profit. Right? Okay. See, it's nothing new about this, even if you think in a normal way. No accounting in this. Normal, a layman can also think in the same way. He started a business with 50,000, which we are calling it as opening capital, and he added 10,000 rupees. Obviously his capital will increase, right? So this is additional capital, and then he took some money out of his business, so obviously his capital will decrease. So that's why we are decreasing 5,000. We will call that as drawings. Right now he has the closing capital of, let's just say, 1 lakh rupees is left with him. So if anybody asks, like even if he thinks how much profit he made during the year, so obviously he will say, so 50,000, 60,000, 60 minus 55, sorry, 60 minus 5, 55. So total capital he invested in the company is 55. right now he has 1 lakh with him. So total profit he made during the year is 45,000 rupees, right? 45,000 rupees he made during the year. So this 1 lakh is nothing but closing capital. So this is like layman can think, right? I started a business with this, and then in the meanwhile during the year again I added some money, and then during the year I withdrawn some money. So that's why he added, so I added it, he withdrawn, so I deducted it, and then he left with 1 lakh rupees. So which made him a profit of 45,000, right? In the same way, but we are doing it in the reverse method. That's it. We are coming because we have this balance, right? So since we are preparing at the end of the year, we are preparing books at the end of the year. So our format will start from here. So we know that closing capital is 1 lakh, and then whatever you have minused here, you need to do plus here. Plus drawings will be 5,000, and then minus, because we added here, so we need to deduct here, minus 10,000, minus additional cap, so that would be 10,000, and then minus opening capital, which is 50,000. How much profit you will get? So 1 lakh 5,000 minus 60,000, you will get 45,000. Same, right? So we have to stick to our format. So our format is closing capital plus drawings minus additional capital minus opening capital. We will get the profit. Okay, but there are some scenarios. They might not give the closing capital, or they might not give the opening capital, right? So to find out the profit, we know our format. Our format starts with the closing capital, right, and ends with the opening capital. What in the question if they didn't mention this? What if they don't have this? Then what should we do? What if they don't give the capital, right? So at that point of time we need to find out the closing capital. So how can we do? Let's just say they gave the closing assets. We all know assets minus liabilities is equal to capital. So if they will give the closing assets minus closing liabilities, then you will get the closing capital. In the same way, opening assets minus opening liabilities, you will get the opening capital. Okay, so we can find out the profit by comparing the opening capital and as well as the closing capital. But the question is, what if they don't give the opening capital and closing capital? So if you want to find out the capital, all you have to do is assets minus liabilities. So if they gave a opening assets and opening liabilities, you can do opening assets minus opening liabilities to find out the opening capital. And if they give closing assets and closing liabilities, you can do closing assets minus closing liabilities to find out the closing capital. So it will look like this. Let's just say this is the closing capital 31 3 2020. So this is at the end of the year. So whatever the liabilities they gave and whatever the assets they gave, those are all closing liabilities and closing assets. So first you will add up all the assets. You will get the 43,000 and minus the closing liabilities, which is creditors and loan. So if you minus from 43,000 minus 16,000 minus 10,000, whatever the balancing figure you are getting, that will be considered as closing capital, right? So in the question they will give closing assets and closing liabilities. All you need to do is prepare one format, put all the liabilities and assets in one place and find out the balancing figure like this, right? So let's start illustration 1. Assets and liabilities of Mr. X as on 31st 12/2015 and 31st 12/2016 are as follows. So that means these are the opening assets, these are the opening assets and opening liabilities. This is the closing assets and closing liabilities. So buildings opening is 1 lakh, they didn't give the closing, so we need to find out that figure also. Furniture is 50,000, so we need to find out the closing. Inventory is 1,20,000, 2,70,000. Sundry debtors 40,000, 90,000. Cash at bank, cash at hand, liabilities, loan and sundry creditors. So decided to depreciate building by 2.5% and furniture by 10%. One life insurance policy of the proprietor was matured during the period and amount 40,000 is retained in the business and proprietor took 2,000 per month for meeting the final family expenses. So proprietor took 2,000 per month, which is drawings, and then the life insurance money what he got 40,000 he retained, that means he reinvested in the business, which is we can also call it as additional capital, further capital, right? So from this we need to prepare statement of affairs. And also why do we need to prepare statement of affairs? Because our ultimate goal is to find out the profit. To find out the profit, our according to our format, we need closing capital as well as the opening capital, right? So we don't have any closing capital and opening capital, but we have the closing assets and closing liabilities, opening assets minus opening assets and opening liabilities. So based on that we can figure it out. So let's start preparing.